Hello and welcome to Majlis and Markets, a podcast where we explore the trends shaping Islamic and global markets. I am your host, Hassan Javraj. If you enjoy this episode, be sure to like, share, and subscribe. And don't forget to leave us a rating. You can also follow us on LinkedIn and Instagram at Majlis and Markets, or drop me a line at hassan@majlisandmarkets.com. Today we're joined by Andrew Naylor, Head of Middle East and Public Policy at the World Gold Council. We discuss gold's role in global markets, its significance in Islamic finance, and what the future holds for this precious metal. Andrew Naylor, welcome to Majlis and Markets. Great to have you here.
Thank you, Hassan. Great to be here.
Andrew, it's really a pleasure to chat to you. I think this is the first time I'm speaking to you. I've come across your profile before, and I did a bit of research last night, as I was saying to you offline, about you and the World Gold Council, and I thought it was really interesting. I also mentioned to you as well, I was reading the report you guys published, and interestingly, last night I was also watching the documentary the World Gold Council did with Idris Elba a few years ago, which I thought was really fascinating. And I'm really interested to get your thoughts on the gold market and where do you think gold prices are going and gold's place in the Islamic finance industry. But before we get into all of that, Andrew, could you give our listeners your early life and your background story?
Sure. Thank you, Hassan. Well, my background is primarily in public policy related issues. So I started my career in public policy consulting with a financial services bent, if you like. And I was looking at things like prudential regulation, customer protection. At the time, I was based in London. This was during the financial crisis, and there was a big focus on things like the retail distribution review, the prudential treatment of banks, broader regulatory financial services issues, and that's really what got me into the gold industry. And one of the unique things about gold is it has a lot of different touch points. So if you think about the supply chain, you have mining and then refining, and there's all sorts of touch points there regarding responsible production, the responsible processing of gold. And then further downstream, if you look at where gold is used, a large component of the gold's use case is in the financial services industry, primarily as an investment asset, which accounts for around about 40% of the annual demand for gold. And that brings you into contact with the issues I used to be looking at: the prudential treatment of assets, the investability of assets, consumer protection, and so on. So the supply chain of gold is really, really diverse, and that's one thing that I really do like about the gold industry. It's just that diversity, and that diversity is also reflected in the different use cases for gold. So I mentioned about 40% is investment, but then in addition to that, you have 20% of gold demand on average every year is from central banks as a reserve asset. You have around about 35% is jewelry demand, and the rest, which is around about 8% is gold use in technology. And that actually is what makes gold really unique. There isn't another asset class that has that diverse demand profile, and it's that diverse demand profile that makes gold behave in a very different way to other asset classes. Because gold behaves in a different way to other asset classes, it can be seen as an effective diversifier within a portfolio, and that's one of the major, certainly, investment use cases for gold.
Amazing. And then how did you end up at the World Gold Council?
Well, I used to be, as I mentioned, in public policy consulting, and I was looking specifically at the time at Basel III. And the Basel III process, and we were looking at gold. At the time, there was something called the LCR, the liquidity coverage ratio, and we're doing a lot of work around whether gold could potentially be an asset within the LCR. And that was really my first introduction to gold, and it opened me up to the world, if you like, because gold is as I said, it's a very unique asset from a demand perspective, but it's also a global asset. And I relocated from London to Singapore back in 2009, 2010, and In Southeast Asia and broader Asia, gold plays a huge role, particularly in household finances. So at the moment, if you look at the where gold is consumed, 74% is now in Asia. Um, Biggest consumer market is China, followed by India, but Southeast Asia plays a major role as well, with Vietnam, Thailand, Indonesia being very large consuming markets. I'm now based in the UAE, and the Middle East is now the third largest consuming market for gold as well. So it's a very global asset class from a demand perspective, but also from a supply perspective. If you'd asked me about supply 30 years ago, it'd be very, very different. South Africa was the biggest producer. Now the supply of gold is very, very geographically diversified, and it's mined on pretty much every continent, and the significant producers all around the world. So it's a global asset class, and that's something as well that has attracted me to the industry.
Amazing. And what do you do at the World Gold Council, Andrew?
I have two hats. So I'm now head of the Middle East. So I look after our operations in the UAE. We have a regional focus, primarily in the GCC markets, but we're also doing a little bit of work at the moment in Turkey and in Egypt. But I also work on policy projects globally. So in the past, that included our work on creating or working with IOFI in Bahrain on a Sharia standard for gold. I'm now looking at other issues, including how do we improve the integrity of the market? How do we embed responsible sourcing rules into things like AML/TF frameworks? So the focus is quite broad. The market development focus is the Middle East, but then I look after, as I said, certain policy projects that have a global footprint.
Amazing. And Andrew, for our listeners who are not too familiar with the World Gold Council, how would you characterize the World Gold Council's mandate and who are its members?
Well, we are the International Market Development Organization for gold. Our members are the world's leading gold mines, so the biggest gold producers in the world. They're our members, and they set our mandate. And our mandate is to make sure that there's continued demand for gold in all its different forms. And we do that in a number of different ways. One, we make the case for gold directly to investors, particularly institutional, commercial and sovereign investors who are big components of certainly financial demand for gold. So we work with end users to increase awareness of gold, how it performs historically as an asset class, its potential role in a portfolio. But we also do other things as well. In addition to the research and the data that we provide on the gold market, we also do a lot of work to improve how the gold market functions. So we have a big focus on market integrity, and that is everything from trying to bring greater visibility and transparency to the gold supply chain, from the mine site all the way through to the end user, to also working with governments to create new market infrastructure and optimal regulatory regimes so that gold can remain a responsibly produced, processed, and traded asset, and that we bring about market efficiencies to the gold market.
Fantastic. And Andrew, I really want to talk to you today. Obviously, we talked a little bit about gold and your background, but you mentioned this in the beginning about why gold is an interesting asset class. I agree with you. I think gold is an interesting asset class, and it's got a unique place in Islamic history. I think I was telling you offline. And maybe could you tell us why do you think gold, or could you elaborate from what you were previously saying about why you think gold is a good alternative asset class compared to say other asset classes?
There are a number of reasons why. Taking a step back, the reason gold is different is because of its very unique demand profile. I mentioned the four major sectors of demand for gold: 33% jewelry, 7% tech, 40% investment, 20% central banks. There's no other asset class that has that demand profile. For example, gold is sometimes compared to crypto, but you don't have jewelry demand for crypto, technology demand. It's not a central bank reserve asset. It's primarily a speculative investment asset. If you look at other precious metals like silver, for example, not a central bank asset, and the industrial use case is much higher. So gold's demand structure is very, very unique, and those different components of gold demand have different economic drivers. So when the economy is an expansionary environment, jewelry demand and technology demand have historically gone up. But when we're in an economically uncertain environment or an inflationary environment, that's when investment and sometimes central bank demand picks up. So because of that diversity of the structure of gold's demand and the different drivers behind those different components of gold's demand, gold performs very differently, and that's reflected in its lack of correlations with other asset classes, particularly in downturns. And those lack of strong correlations in downturns mean that gold can be an effective risk mitigator, a portfolio diversifier. So that's one reason why gold is unique because of its diversification properties, but it's also a very, very liquid asset. So over $220 billion a day of gold is traded, which makes it more liquid than many other major asset classes. And it can also generate returns over time. So if you look at the performance of gold since 1971, which is when the United States opened up the private investment market to gold and started to unwind the gold standard at the time. If you go back to 1971, the average annual return for gold has been about 8%, which means that its performance is comparable of equities and is higher than that of bond markets, for example, over the same period. And it's outperformed many other asset classes. So for those reasons, its long-term returns historically, its potential role as a diversifier, and its liquidity comprise what we describe or call the strategic case for gold. So that's the reason why an investor might be interested in gold as an asset class. But it's also unique because it's a physical asset. It's both historically it was a currency, but it's a commodity. There's a commodity element to gold, but it's a physical asset. So when you own it outright, if you're in physical possession of it, or if you have constructive possession and the gold is allocated to you, which is a way of holding gold, there shouldn't be any other counterparty risk. So from that perspective, and because of the gold's historic performance and its role, it's considered by many to be a safe haven asset, which again is another uniqueness of gold and one of the reasons why investors are interested in it.
Yeah, it seems like it's also like as you mentioned, right, is a good store of value. And like a lot of people say to me when I was talking to investors over the past couple of years, they say it's a good hedge against inflation. So like we've been in quite an inflationary environment over the past couple of years, especially in Islamic markets. Do you think that it's a good hedge against like things like inflation?
Yes. So historically, gold has been an effective hedge against inflation. If you look at how it's performed historically in periods of high inflation, so that's when inflation is above 3% or 3% or above. The average annual return for gold has been somewhere like 12-13%. So the way it's performed historically suggests that it could be an effective hedge against inflation. And certainly what we see is that in inflationary environments, gold tends to perform better, again, historically. And I talked about the correlations. The one, I guess, main correlation that gold has, but it's an inverse correlation, is between the US dollar. So when the US dollar is performing very well, gold that represents often a headwind for gold. Similarly, US interest rates, which of course link to the value of the US dollar. So when we're in higher interest rate environments, the opportunity cost of holding gold, because gold isn't an income-bearing asset, because it's a physical asset, the opportunity cost of gold is higher. And so historically, in higher interest rate environments, investment demand for gold has tailed off. But again, gold is unique in terms of its demand structure. It's a dual asset. You have investment demand, and you also have consumer demand for gold in the form of jewelry and technology, and for example, which makes gold perform differently to other asset classes.
Yeah, what's interesting if you look at the gold prices, you mentioned like about the US dollar and interest rates. Although like US treasuries are like offering 4.5%, it seems like gold prices are still quite high since 2021 and 2022. What's behind that?
There's been a few major drivers. Certainly, if you look at last year, where we had 40 record highs, it was really a tale of two halves. So the first half of the year was more about consumer demand for gold, particularly in China and India. Consumer demand for gold in China that tapered off, partly because of the economic situation in China, but also higher gold prices. When you have higher gold prices, jewelry demand in particular, which is a large component of consumer demand, that tends to be more sensitive to higher prices. So when the price is high, people buy less jewelry. Underlaying all of that, though, the foundation, I would say, to everything that happened last year and the last couple of years has been the central bank interest in gold as a reserve asset. Central banks have been net buyers for gold since 2010, but it's really been the last few years, and we saw a record high in 2022. Central banks, particularly from emerging markets, have been large buyers of gold, and they've been consistent. And it looks like 2024, when we will be releasing our figures soon, but 2024 will be a very, very robust year for central bank interest in gold. And so they have been hugely supportive of gold's performance over the last few years, but especially last year. So you've got that central bank foundation to the last few years, but layered on top of that, you've had retail interest, particularly in the first half of last year. When that started to taper off, you had institutional investment interest, particularly in the United States in the second half of the year, that really resulted in gold's 40 record highs last year.
Why are central banks buying gold?
They buy for a number of reasons, similar to other institutional investors. It's really about safety, though. Safety, gold is seen as a safe haven. It's a physical asset, so central banks will own it outright. Sometimes they will custody it themselves. Sometimes they will custody it at other central banks, like the Bank of England, which is a major custodian. But the point is, they're using the Bank of England as a custodian. They own the gold, and so their counterparty risk is limited. But major reason for central banks holding gold is one of safety and its safe haven properties. Second, it's liquidity. As I mentioned, $220 billion of gold is traded every single day. So it's a very, very liquid asset. What does that mean in practical terms? It means that if you need to sell it, you can, and it's easy to sell. And that can be for large institutional investors. That's obviously in the wholesale markets, often the OTC market. London is the terminal market for gold, where a lot of the OTC trading activity takes place. But when you think about individuals, what does liquidity mean for an individual? It means that you can go to Bangkok, Chinatown, you can go to Dubai Gold Souk and sell your gold. So in practical terms, it's considered a liquid asset. The third reason is one of performance. Now, commercial institutional investors, they are motivated by similar factors, but the weighting that they would apply to each factor is a bit different. So for central banks, it tends to be more about safety and liquidity, less about performance. For commercial institutional investors, it's more about performance, liquidity, and safety as well. So it's just the emphasis they place on those attributes is just different. But overall, the rationale is the same. Now we produce an annual central bank survey. It was released in June last year. We'll be doing the same again this year. And when we published the data last year, what was very clear from the interactions that we've had through our survey of central banks was that the outlook for central bank interest in gold was very, very robust. 81% of respondents thought that gold was going to play a bigger role as a reserve asset going forward. So the outlook for central banks remains robust, and that's reflected in the outlook that we've recently published.
Andrew, one thing I wanted to ask you, maybe from your personal opinion and your experience, is that when you mentioned about the removing of the gold standard in 1971, and we know the reasons why the US, and there's a lot of people who've been commenting on this, but there's been a lot of noise and talk over the past couple of years, particularly with the BRICS and the global South countries talking about a gold-backed currency. And like we've been in like 17 years since the global financial crisis. Would you say that now is probably the right time to have a gold-backed currency, whether it be in, let's say, the Western world or in the global South?
No, I think that there's certainly a lot of discussion and debate and noise about that. My personal view is I think it's unlikely. Once you've come off a gold standard, it's very, very hard without significant um, global financial disruption to go back onto it. But gold is playing, a bigger role in individual and household finances, and that's reflected in some of the consumption figures. It's reflected in the growth of gold as an asset class and interest in it as an investment asset. Um, Certainly, it plays a huge role in macroeconomic stability. That's why central banks entrust their national wealth or a significant component of their national wealth into gold. So it has a hugely important role when it comes to macroeconomic policy, to protecting national wealth, to protecting broader financial system stability, and that, I think is going to continue. There are a number of different scenarios. The US dollar, is the primary reserve asset. It's the primary trade settlement currency, and that's because countries trade a lot with the United States. That may change over time as different economies evolve and emerge. We might, in the foreseeable future, have a more of a multi-currency composition to reserves or to the currency that's used for trade settlement, and gold could play a bigger role in that for sure.
Amazing. And Andrew, I just want to shift a little bit to the Islamic markets. I know you spent time in Singapore and now you're in the UAE. How would you say key Islamic markets or Islamic countries are positioning themselves with regards to gold? Do their policies, do you think, are positive, or do you think they need a little bit of more refinement?
It's a very interesting question because gold has a unique place in the history of Islamic finance. It has special treatment as a Ribawi item. Something we were looking at historically or a few years ago, was the Sharia treatment of gold, because there was a big debate about whether gold could be used in commodity form as well as currency form. And so we worked with partners initially in Malaysia, in KL, but then in other markets, and eventually with IOFI in Bahrain, to clarify this. And then to clarify the broader Sharia rules around gold as an investment asset. And the reason we wanted to do that was just to bring about clarity, to basically understand what the rules were, and then within those rules, develop products that could be considered Sharia compliant. And so that standard was launched back in 2016, and it's used now by some governments that have national Sharia standards. It's used by some of the large Islamic banks to inform their boards about the structuring of Sharia compliant gold products. And I think that was a very important thing to do, because Islamic finance is growing. The Sharia compliant assets under management is growing, and we wanted to make sure that there were Sharia compliant vehicles for investing in gold. And because of gold's unique place in Islamic finance, its history in Islamic finance, but not just in Islamic finance, but also its history in the broader Middle East region in particular, it's inevitable that there's going to be significant interest in gold.
Yeah, no pun intended. But with the Islamic finance, one thing was interesting is I was writing an article a few weeks ago about Islamic exchange traded funds, and when you look at the size, the gold-backed ETFs are some of the biggest. So I definitely think that gold can play a role in Sharia compliant transactions. But do you think there still needs to be more adoption from mainstream Islamic financial institutions?
Yes, I think because the starting point has been offering retail products. So gold investment accounts. One of the biggest debates that was had at the time was whether you could hold gold um, uh, uh, or possess gold constructively, or whether you had to take physical possession. Now, what the IOFI standard said was that possession could be constructive. So that meant that you could, as long as the legal title it changed at spot to the end investor, end consumer, that was fine. And as long as there was an ability to redeem physically as well. But what that meant was that rather than just say buying a bar and coin over the counter and taking it home, which can be very costly, you've got to think about insurance, you've got to think about cost of transport, but also you've got to think about the ticket size. A kilo bar, for example, at current prices is about $80,000. That's a lot to many people. A gold investment account allows you to um, uh, invest in a gold bar, but it could be fractionalized. So that means that you could own part of a bar, and that bar is stored on your behalf, so you don't have to worry about the logistics, the insurance, and so on. And what the standard permitted was that as long as that gold was allocated, so each bar has a serial number, it should be identifiable, so the end consumer investor should know which bar they have full or partial ownership of, but it was permitted for that gold to be custodied by a third party. That opened up the opportunity for new products, in particular products that appeal to the more retail market that perhaps haven't accumulated enough wealth for a large bar. I mean, those large bars that you see in films are usually about 400-ounce bar. These are $1 million each, so out of the financial reach for many. But a combination of the IOFI standard plus new innovations in digitalization and tokenization and so on means that you can fractionalize a large bar. So you can open up access to the large bar market to the retail market. So the focus initially has been on products like that, retail focused investment products. For the larger institutions, though, gold-backed exchange-traded funds are a potential option. Again, the standard set out rules that meant that some physically backed gold ETFs could be considered Sharia compliant. It's important to obviously do due diligence. I think an area that we could be looking at is to raise awareness. In some markets like Turkey, there's huge awareness of the opportunities of gold in Islamic finance. In fact, the Turkish banks offer perhaps the best case study and example of how gold can be used. They have all sorts of different innovative products, not just gold investment accounts, but Sharia compliant gold certificate programs, gold checkbooks where I could write to you a check denominated in gold without a cash leg. So I could send you a check and it would say 3, 4 grams, whatever it is, and you would have 3, 4 grams of gold credited into your account. There's no cash leg, which is hugely innovative. But also in the wholesale financial system in Turkey, gold is playing a big role. You have gold-backed sukuks there, for example. So I think there's an opportunity for other markets to look at that, to learn from it, and potentially to emulate it. So the focus for us now is just to raise awareness of the role that gold can play, but then also raise awareness of the new and innovative Sharia compliant gold products that are available or potentially available to the market.
How important is it for the likes of a place like Dubai, which is a key trading hub for gold, to facilitate all of this?
I think it's hugely important. It's a growing market. Dubai is obviously a a major international financial center. It's a wealth management center. It's a hugely internationally and diverse market. And so it's inevitable and important that Sharia compliant or Islamic finance plays a role here. And in fact, a lot of the Islamic banks here are innovating and are starting to look at gold. So Dubai's role is hugely important because it is a center of innovation in both Islamic and conventional finance.
And then when they're like interacting, not specifically to Dubai, one of the things I think that was quite interesting in researching was that, is there any kind of like AML KYC risk for, say, a counterparty in, say, the Western countries that wanted to trade with an Islamic country?
I wouldn't characterize it perhaps in that way. That there are AML risks associated with gold. Um, Wherever. I mean, gold is a fungible asset. It can be melted, and when you melt it, I guess the beneficial ownership and the trading and the production history of the gold can be erased. So there are unique AML considerations around gold, but very robust frameworks are being put in place. Um, for example, the DNFPB sector, the designated non-financial professions and businesses sector, has had a lot of focus, and a lot of the focus has been on AML processes and procedures, on things like customer due diligence, on looking at how transactions are structured. Something that we are looking at is how can we best integrate those responsible sourcing rules with AML TF rules, because AML procedures and rules tend to focus on the profile of the transacting counterparty, the customer, and also on the cash leg of a transaction, or the currency leg of a transaction. With gold, you also have to think about where that gold has come from, how has it been produced, has it been produced from a responsible source? Do you have visibility over the supply chain? Have you done due diligence not just on the transacting counterparty, i.e., the entity that is either selling or buying gold from you, but have you done due diligence on where that gold has been produced and how has it been traded historically? And so the UAE has put in place a lot of new rules very recently, or in the last couple of years, on, for example, mandatory sourcing rules. So all refineries that operate in the UAE now have to adhere to mandatory sourcing rules and are subject to audits. So robust frameworks are being put in place. Something that we're looking at, though, at the World Gold Council is how can we leverage the latest technology to bring greater transparency to the supply chain? And so we're looking at it from two perspectives. One is creating a distributed ledger-enabled database of all responsibly produced gold, so that you have a one-stop shop, if you like, to check whether that gold has been responsibly produced. And we've been working with partners worldwide on developing that. The second area has been looking at the latest technologies that can bring greater confidence to undertaking due diligence on where the gold has actually come from. So, for example, there are new technologies that allow you to use the unique metallurgical chemical footprint of a mine site as a marker that's reflected in the doré. So what comes out of a mine site is doré, unrefined gold that contains lots of impurities. And you can use those impurities as a little bit like a DNA marker, naturally occurring, that allow you to map it back. So map that doré back to the original mine site. Now, the ability to detect impurities has been around for decades. What's new, though, is big data analytics. Potentially, there's a role for AI now as well. And it's that analytical developments that allow us with much higher degrees of confidence and certainty to be able to map back the doré to a specific mine site. And that will only enhance responsible sourcing practices, and that's a big focus for us at the moment at the World Gold Council.
Amazing. And Andrew, just sticking with the GCC countries, do you see other countries in the GCC like enhancing their gold trading or gold their place within the gold ecosystem?
Yes, the GCC is, is a big market for gold and plays a big role in the global gold market. The UAE has the biggest role when you look at its role as a gatekeeper. So it's the second largest physical trading hub for gold now. Third largest importer, third largest exporter, but in aggregate, second largest trading hub in the world. There's a lot of processing that takes place here, refining, jewelry fabrication and consumption as well. But a lot of that consumption is driven by the tourist trade. Other markets in the GCC play slightly different roles in the gold market. Saudi Arabia, for example, is a big consuming market for gold. It's a very, very large jewelry market. Bar and coin investment in Saudi is growing significantly as well. There's a lot of institutional wealth that is being allocated to gold in Saudi, but Saudi is also a producer. It's the only producer of gold really in the GCC. So by that I mean hosting gold mining production. And then other markets, some of the smaller markets like Bahrain, Kuwait, for example, Oman, are significant fabrication centers, not just for their own domestic market, but for export as well. So the GCC plays quite a diverse role in the global gold market, and the growth of the region really has sort of underpinned the growth of the gold market here, and that's in line with our global analysis. So when you think about the drivers of gold's performance historically, there are lots of specific factors that have had an impact on the market. So, for example, in the early 2000s, when China opened up its gold market, when in 1971, when private investment in gold was permitted in the United States, and there are other specific events that have had an impact. But the long-term driver of gold's performance has been rising incomes, has been GDP. And this region, the GCC, is a huge driver of contributor towards global growth, significant GDP increases here, and that really is what's underpinning the success of the gold market in this region.
Looking more broadly in the region, Andrew, one thing that was interesting is that I was quite surprised to read that Iraq is also a big adopter. Do you see like these non-GCC kind of Middle Eastern countries adopting gold more in their economic strategies?
Yes, I mean there's a large cultural affinity for gold because of the historical role that gold has played in finance, in Islamic finance, but also culturally as well as it's an adornment. It plays a big role in many different cultures in terms of weddings and festivals and so on. And so there are countries in the region that where interesting gold is growing. Sometimes that's driven by macroeconomics. Egypt, for example, Egypt used to be a much larger gold market than it is now, but in recent years we have seen renewed interest in gold, and it's often, or for many markets, it's linked to the performance of local currencies. When local currencies are perhaps a little bit more volatile than people would like, gold is sometimes seen as an alternative and a store of value, and plays a large role in individual and household finances. Turkey as well is another major market for gold, a hugely significant market for gold. Turkey has played a role in the gold industry for centuries, in fact, millennia. The first gold coins were minted in Lydia, which is in modern day Turkey. You've had mining in Turkey and Egypt, North Sudan, in Saudi, that has happened for centuries and centuries as well. So gold has played a large and diverse role in the wider region.
Amazing. And Andrew, as we bring the podcast to a close shortly, we're now in the end of January. We're recording this on the 31st of January. And we've had like maybe 2 weeks of Donald Trump or coming up to 2 weeks of Donald Trump being in office. How do you see gold prices going under Trump 2.0?
Well, when we think about gold's performance, we've got to look at those different sectors of demand: jewelry, tech, investment, and central banks. I've spoken quite a bit on central banks, and the outlook for central banks is positive. So let's just focus on investment, which is really what has been driving gold's performance, certainly in the last 6 to 9 months. And the outlook is still positive. We are forecasting strong investment interest in gold, mainly because of the interest rate cutting cycle. They weren't cut as aggressively as perhaps we thought they would be last year, but we're still expecting interest rates to continue to come down. That is usually a tailwind for gold. It's supportive of gold because it reduces the opportunity cost of holding it. And there's lots of uncertainty on the horizon. Without going into the specifics, there is a link between geopolitical uncertainty and gold's performance. For every 100 basis point increase in the geopolitical risk index, which is a global index of geopolitical risk, gold historically has performed by an extra 2.5%. So as geopolitical risk goes up, interest in gold often goes up as well. We are at a bit of a geopolitical crossroads, and that uncertainty, that economic and that geopolitical uncertainty, is likely to be a driver of gold's performance. I think the biggest thing though is what's happening with interest rates. Linked to that is inflation, and there's a bit of an antagonism there because we're expecting some of the policies of the new administration to be inflationary, which will obviously have an impact on the timing and cadence and depth of interest rate cuts, and so that's leading to a little bit of uncertainty. But we do think that in the medium term, the outlook is positive.
And Andrew, like when I asked you about the gold-backed currencies, a lot of countries seem to be doing, they want to go to de-dollarization. Do you think this will also contribute to gold prices going higher in 2025?
I mean, potentially. I mean, the de-dollarization. I mean, there's a we as I mentioned, we have a survey of central banks, and the outlook, for the US dollar component of central bank reserves is still very positive. This is not going to change overnight, but supply chains are evolving. There's I guess, a regionalization of supply chains. The growth. So you mentioned BRICS earlier. A big change that's happened, if you looked at intra-BRICS trade 20 years ago, it was perhaps about 23% of their external trade. For some BRICS countries, that's gone up to over 40%. So, as countries trade more bilaterally with each other, the trade settlement currency that's used will inevitably change. That eventually could impact the accumulation of forex and the composition of accumulated forex, which is then one of the reasons for the composition of reserves. I think gold, as I mentioned, as a reserve asset, the outlook is positive, and so I think gold will continue to play and perhaps play a larger role as financial systems evolve. And one of the drivers of that evolution is changing trade patterns.
And one thing that just came to my mind, Andrew, is like obviously cryptocurrency and particularly Bitcoin have been rallying a lot since Donald Trump was elected in November. Do you think that gold is a better alternative? Maybe I don't know. Maybe if you have a view on this, do you think gold is a good alternative compared to, say, other alternative assets?
Well, it's very different, and that's what makes it good. A couple of years ago, people started to question, well, is Bitcoin the new safe haven asset? Is Bitcoin or crypto more broadly going to replace gold? I mean, the answer to that is no. And it goes back to that unique demand structure for gold: jewelry, tech, investment, central banks. It's that unique demand structure that means gold behaves and performs differently as a financial asset to any other asset class any other asset class, including crypto. Crypto is primarily a speculative investment asset. It doesn't have jewelry demand, doesn't have tech demand, doesn't have central bank demand. That means it tends to be more highly correlated to equities, for example. It's more pro-cyclical, and gold can be an effective diversifier of that risk. And with crypto, you do have risks, as you do with every other asset class. You have risks. Even with gold, you've got market risk or price risk. But with crypto, you don't have a settled regulatory regime, so you've got regulatory risk. But then you've got counterparty risk. How do you verify your counterparty? You have market risk, which you get with every asset class. And so, if you are allocating to crypto, that's not without risk. And so there is potentially a role for gold to mitigate and diversify some of that risk away. So in some ways, they can be seen as complementary, but they are very, very different asset classes. And I think I would just finish again and emphasize the reason gold's different is because of that very unique demand profile for gold: jewelry, tech, investment, and central banks. And each of those components of gold demand has very, very different drivers. Some are expansionary, some are pro-cyclical, other elements are counter-cyclical. And gold reflects that by performing differently to other asset classes. That difference in performance is reflected in the lack of strong correlations, particularly in downturns. And that makes gold potentially a unique risk mitigating asset in a portfolio.
Fair enough. Andrew, tell us any projects you may be working on, any upcoming projects you may be working on.
Lots of different projects. So one of the roles of the World Gold Council is to educate and inform. So we're undertaking market research, consumer market research here in the UAE this year. So we'll be looking at jewelry demand in particular, but also bar and coin, and finding out what investors here think about gold, the role that it plays in their own individual and household finances, the product features that they find particularly attractive, trends, and so on. And we're hoping that that will support the industry, because the industry can use the insights to develop new and innovative and ultimately attractive products. Linked to that, we're also working on something called the Retail Gold Investment Principles. This is something that we have launched globally, and we've launched them in India, in Singapore, and we're doing a lot of work in the US, in Germany, and in Australia and other markets as well. And the Retail Gold Investment Principles are a code of conduct for the retail gold industry, because gold isn't a regulated asset class. It doesn't fall under the scope of securities regulations, for example, unless the structure, the vehicle for investing in gold might be, for example, a gold ETF, but the underlying asset falls out of that scope. And what we wanted to do was to create a set of best practices that supports the retail industry and identifies and differentiates the good players, so that consumers can be more comfortable in dealing with the counterparty. And this goes back to the consumer research that we've undertaken in other markets. We also ask consumers that are considering investing in gold but haven't yet invested in gold. We ask them why. And we ask them why because we want to find out what the barriers are. We would like ultimately people to recognize the role that gold can play in individual and household finances. So asking people who are interested in gold but haven't yet bought gold, what's holding them back, we think is very, very important. And one of the biggest factors that came back consistently across all markets was a lack of trust. So not being able to trust the counterparty. And so we developed the Retail Gold Investment Principles to address that, so that retailers, bar and coin dealers and jewelry retailers can coalesce behind a framework, a set of best practices to generate consumer trust. And hopefully that consumer trust will be translated into greater confidence to buy gold.
Amazing. And how can people read more about that?
Everything is on our website. So I would urge people to go to goldhub.com, goldhub.com. It's all free. All of our research is free. We also have lots of tools as well. So we have a valuation framework, which allows you to put into a model which you can interrogate your own assumptions about the different factors that will impact gold and come out with a future valuation. We have a portfolio optimization tool, so you can put in the construction of your portfolio and see what a different allocation to gold would mean for that portfolio. And we have something which is backward looking called the gold return attribution model, which explains the factors that have influenced gold's past performance. All of that and the research and the data that we publish is on goldhub.com, and it's freely available to access.
Amazing. And Andrew, are you active on social media? And how can people get in touch with you?
I'm active on LinkedIn, so please do connect with me on LinkedIn, where I often post about our latest commentary and research and provide gold market updates. So feel free to connect with me on LinkedIn.
I'll link it in the show notes after our conversation. But Andrew and Ida, this has been a fantastic and really insightful conversation. I've learned a lot about the gold market and what the factors are driving it. And I really thank you again for coming on the podcast.
No, thank you very much, Hassan. It's very nice to chat.
If you made it this far, you must have enjoyed that episode. If you did enjoy that episode, don't forget to like, share, and subscribe. It really helps us bring you more great insights. Follow us on LinkedIn and Instagram for the latest updates. Got feedback or guest suggestion? Email me at hassan@majlisandmarkets.com.